Hi, everyone. Thank you so much for joining us today. I'm Marcia Butler, the webinar director here at Advice Chaser, and we want to thank you for coming as you are filling our webinar room. And before we introduce our guest, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions and leave comments using the chat box. I do need to turn that functionality on. All right, that is on now. The presenter will answer those queries during or after the presentation today as appropriate. And if you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. And if we can't get to your question, we'll make sure someone reaches out to you after today's event to make sure that gets addressed. Again, we want to make sure this experience is as educational as possible. So please don't hesitate to ask for clarification or expansion of the material. I'd like to introduce you to our presenter today. Alec Bethurum is the Senior Portfolio Manager and Senior Financial Advisor at Sternick Capital. Alec is a graduate of Colgate University and has spent almost 25 years working on Wall Street. He has previously been employed by Bear Stearns, Prudential Securities, and Roth Capital, working in equity research, sales, and trading. Alec also worked as a proprietary trader for a West Coast-based hedge fund. Over the years, Alec's contribution to client success has evolved from focusing purely on securities research and asset allocation to a more holistic advisory role, including involvement in behavioral finance, tax, and financial planning. Sternick Capital has been offering clients investment management and financial planning insights for more than a quarter century. Founded in 1989 as a New York City-based hedge fund, the practice moved to Kansas City in 1999 and transitioned to offering individuals and families access to institutional level financial planning and asset management. Today, Sternick Capital is proud to be a fee-only firm with a fiduciary responsibility to put its clients and their needs first. And Alec, I'm excited about this webinar today. Lots of investors, hopefully on this call, potential investors, and excited to learn what you have to say today.
Thank you, Marcia, for having me, and thank you to everybody for joining us today. Title of today's webinar, Timeless Lessons on Investing and Becoming a Better Long-Term Investor. And, one thing that I really want to try to convey to the audience today is, our goal is really to simplify your strategy. And, that's what we think the best kind of, strategy to pursue in the long term. And there's kind of a famous quote out there from Einstein, make something as simple as possible, but no simpler. And, that's kind of how we think about investing. We think, a lot of times people in our industry tend to try to make things more complex than they really are. And, the driver behind that is really, from a marketing perspective, if they can make you think that they have, some expertise that they don't, or something's more difficult than maybe it is, certainly that potentially makes you a more amenable client. So, our goal today is to try to kind of cut through some of that and, provide you, with some information that we think, will allow you to kind of better recognize, when something's being sold to you and, hopefully, have you take a longer term perspective in how you think about, both investing and the companies that you're investing in. So with that, I just kind of want to really start out from the very top, because a lot of times, people forget what investing really is. And a lot of that has to do with, like I say, watching things on CNBC, being very concentrated on short-term news or on, a particular stock's movement that day. But, at its core, what investing really is laying out money today and expecting to get more from that money in the future. That's really all it is. It's not speculating. It's not, buying options. It's not trading. It's really laying out that money today and expecting a return in the future that's greater than the money that you laid out initially. So if we go to the next slide, it's important, all of us kind of see all the time that, the stock market on a long-term basis has grown over time through all kinds of different situations. And so once again, trying to simplify, the reasons behind that is, why does the stock market go higher over time? Well, the fact is that, capitalism has an excellent history of creating, economic growth and wealth. And, why is that? Well, that's because people go to work every day. Those people, come up with, entrepreneurial solutions to problems. Those people that develop those solutions go out and raise money, and, they can either use natural resources to go ahead and grow their wealth, or that intellectual capital to go ahead and grow the wealth. So, think of a technology company, that's primarily going to be intellectual capital that's going to drive the growth. A mining company might be something that's going to, utilize natural resources. But, at its core, the economy is millions and millions of people going to work every day using their labor and their intellectual capital to grow. And that really has, nothing to do with the upcoming quarterly earnings for XYZ company. So that's something just kind of, keep in the back of your mind as you kind of think about, what you own and why you invest. And, this is just the fact that over time, investors are going to benefit from people putting in, all of those inputs to grow the economy over time. And this is just, a very long-term chart of the stock market all the way back to, kind of pre-depression 1925 to, through kind of 2021, 2022. And, you can see that, there's a lot of permutation, but in general, it's up and to the right. And the driver of that is all those things we talked about on slide 1 and slide 2, which is, employing those various resources, capital, et cetera, to grow. So that's kind of sets the stage for, how the world works in the long term and why you own investment securities. This is just kind of now talking about the difference between, why do you own a stock and what does it actually mean when you own a stock? I think people have kind of forgotten, now that we've gotten away from, paper certificates and those kinds of things, that, when you own a stock, you don't necessarily own something just to be sold at a higher price. What you actually own is the piece of an operating company. So, when you own stock of IBM, you're owning all that intellectual capital, Salesforce, computer technology, et cetera, that they have. They're selling those goods and services to others to create a profit. That's what you actually own, not a piece of paper to be sold. And the reason that we buy a stock is that so we can own a piece of the future profitability of that operating business. And I think, sometimes people get so far away from that, they get so myopic and focused on the short term that they forget the reason that they actually own a stock. And so we think that's very important kind of as a basis. It also allows you to weather the day-to-day volatility a lot more readily, because you're not thinking about it as a piece of paper whose price is moving around. You're thinking of it as an actual operating business. And so I think that's important to kind of preface what we talk about. On the next slide, so here's the other part that's very important. So, when a company produces profits, those profits can either come back to shareholders in a couple of ways. One of the ways that they can come back to shareholders is through a dividend. That's okay. There's nothing wrong with those profits coming back as a dividend. But ideally, in a growth business, if you really want to grow your wealth over the long term, what you'd like to see happen is for the operators of that company to reinvest those profits to continue to grow the company. So, if you think about it this way, let's say XYZ company has $1 million profit. They could send that back to their shareholders, and the shareholders could then, say buy a treasury with a 3 or 4% return. That's fine. But what you really want to have happen is for the operators of that business to take those profits and invest in expansion into new product lines, invest into new factories, et cetera. And that's how you're going to get the compounding effect or the long-term growth of that wealth. And if we go to the next slide, one of the most famous, capital allocators and compounders of wealth is Warren Buffett at Berkshire Hathaway. And though this here just compares, the chart of Berkshire Hathaway back to 1990 versus the S&P 500. And if you think about all the good things that have happened in the S&P 500 since, the 90s, but then you see the performance of Berkshire Hathaway, versus the S&P 500, that is a function of Warren Buffett and Charlie Munger being exceptionally focused on reinvesting and compounding those profits that their businesses generate into other businesses that are also going to generate, similar type profits. So, the power of compounding, and I don't know, how many times people have seen it, but it's very interesting to show a kid or a grandkid, saving $10 or $20 a week or something like that and compounding it at a rate. You get this, big kind of hockey stick upward chart as you grow. Same thing with stock investing. And that's the reason why you want to hold these securities for a long term. And that's also the reason why we, in general, for the stock portion of a portfolio, favor companies that are able to reinvest those profits into other endeavors that are going to, return similar levels as what their original business did.
Hey, Alec, we have a
Yep.
question here. What about a company that is public, but it's not making money yet, and yet the value of their stock is still going up? Can you talk about those kind of?
Yeah, I mean, in general, it's a very difficult situation because really the only value of a company or the only reason that you own an investment is that it's going to generate a positive return on the capital that's invested in it. Now, the reason why some stocks at certain times tend to be unprofitable, but still, generate, price improvement. So not investor returns. Nothing that's profitable isn't generating any investor returns. It's generating price appreciation. So it goes back to what we had a minute ago, the idea of owning an operated business versus owning a piece of paper that you're hoping to exchange to someone who's willing to pay more for that piece of paper. Now, there is an underlying thesis to that, which is that the company that's not generating profits today, you're hoping that in the future that there's going to be significant profits generated, and you're willing to wait longer or pay up today, for those profits, because your argument might be that those profits are going to be so high that it's okay to wait. Now, for us in general, we try to avoid those situations. Like I say, that kind of changes more to speculation versus investing. We would rather see, let's say there's 2 or 3 unprofitable companies in, big buzzword right now is artificial intelligence, AI. Let's say there's 5 companies out there that are, in that space. We'd rather wait to see, which one is actually going to have a dominant technology and grow and those kinds of things rather than speculating in advance. And I don't know if anyone's seen, Warren Buffett, they just had their annual meeting. And, one of the things he talked about was, if you'd have been there when the Wright brothers invented flying, you'd have thought you'd have, greatest thing ever, you put your money in. Well, the fact of the matter is, there's really been no truly profitable airlines, or the airline industry as an industry hasn't been profitable over all those 100 or 150 years kind of thing, since the plane was originally, invented. So just because something is a compelling technology doesn't mean it's going to be a profitable business. And like I say, that's really speculation. That's not investing. So this is the other kind of important part, the power of waiting. We get so, particularly in this day and age where there's so much news being flashed in front of us, and particularly when, stock prices, it wasn't that long ago that, you actually had to call somebody up to find out the price of an individual security, even back into the 70s. Now it's on your phone every day. It's on TV every day. It's at the airport, everywhere you go kind of thing. So, our mind is kind of sped up as far as, how we expect an investment to move. But the truth is, these are businesses. So they're not pieces of paper. So the value of a business is not fluctuating by wide amounts on an hourly, daily, weekly, even monthly basis, right? These are businesses. And so if we're owning businesses that are going to grow and compound, we need to be patient enough to allow that to play out, and also be confident enough that, if they are growing, that eventually the value of that business is going to appreciate in the stock market. So that's very important. There's just kind of that quote there, you don't get paid for activity in the stock market, you pay for waiting. So you pay to, you do your initial work, you find something that you like, and that could just be the stock market in general. And then you wait for all those levers that we talked about. You wait for that wealth accumulation. You wait for that, the growth of that business to materialize. And that's what's going to generate your wealth over the long term. We go to the next one. So this is kind of the flip side of that, right? So, short-term predictions are extraordinarily hard to do. And, certainly there's really no one in the world that's been able to consistently, make accurate short-term predictions. Conversely, it's much easier to make long-term predictions and to, like I say, I can't really predict what the stock market's going to do next year or even the year after, but I can, not quite 100%, but I can be extraordinarily confident that over a 10-year period, the value of your stock investments is going to grow. And, we just kind of say flipping a coin down there as an example, right? If we start flipping a coin, we might get 5 or 6 heads in a row on the first, 7 or 8 flips that we make. We might get 20, we might get 25 out of the first 30 might be heads, something like that. But as we expand that, if we get out to 1,000 flips, 2,000 flips, 10,000 flips, it's highly likely that, the number is going to be close to 50-50. So, the analogy on that is, right, any one flip, we have no idea. Over 10,000 flips, we can accurately predict that something's going to be close to 50-50. And so if you go to the next slide, the same thing is the case in, all kinds of securities markets. And, these are different ones. I want you to focus just on the one all the way on the right there, which is global equity. And you can see that brown line, this is back to 1983 through 2018. In any one given year, what was the variance in performance of the equity markets? And so you can see over that, 35-year time period, the market was up as much as 66% in one year and down as much as 47% in one year. But then you can see as we start to move out to the right of that brown line and we expand our time horizon from 5 years to 7 years to 10 years to 15 years, you can see that the variance comes down and down and down until over the entire breadth of the period that we're talking about, you've got that 9.3% annualized return, which is pretty close to what the market's experienced over, 50, 100-year timelines, that kind of thing. So it's very important. I think this kind of, allows you to visualize that, on that single coin flip, very, very hard. That would be a 1-year period of the stock market, but over 1,000 coin flips, in this case, that's 15 years or, even longer than 15 years, 35 years, that, that variance gets a lot lower and, your total return becomes a lot more predictable. So this is kind of another part. This is Mr. Market. This is kind of a famous, quote from Ben Graham, who was Warren Buffett's kind of mentor. And, this is kind of an allegory, but I think it's kind of interesting. What he talks about here is, there's a man named Mr. Market, and every day he'll come to your door and he'll knock on your door and he will offer to buy all of the securities, that you currently own. And, some days Mr. Market has had a great day the day before, everything's gone perfectly. He's euphoric. He'll come to your door and he'll offer you a very high price for those securities. And, another day he might have, had a bad morning, bit by a dog, whatever it might be. He's going to show up at your door and he's going to be extremely pessimistic and extremely down and depressed. And, if you think about it, that is a pretty nice kind of, way to think about the stock market, right? There's certain periods of time, where the market is going crazy. Everyone's euphoric. It really wasn't that long ago, kind of post COVID, those 6 months after, we realized that, maybe COVID, while being, pretty bad, wasn't maybe going to be as bad as the market originally anticipated. A lot of capital from the Fed came into the market that they were using to support the economy. And, the market was straight up. Every day there was some story in the newspaper about, some college kid or teenager who'd made a giant sum of money in, some certain options position or something like that. And then, conversely in 08 or 09, for those of you who were around then, at that period, everything was going to zero. Nothing was ever going to go up again, et cetera. So that's kind of that allegory for Mr. Market. And what we want to try to do is, use Mr. Market to our advantage. So because we have a long-term perspective, we want to, try to obviously buy during periods where people are more depressed, sell during periods where they're more euphoric. And I always just kind of like this chart because, recently we had, last year, maybe a 20% pullback over the course of the year, and people kind of act like that's a very significant deal. And, it is maybe in the short term, but, Mr. Market is kind of more manic than you think is kind of the title of this. And, what this shows you is it's very, very common during any given year for there to be a drop of 10% or more. And you can just see that, those are kind of those gold lines there. You can see all the years that the market has finished up, even years when it was up as much as, 30%. There were periods where it was down 10, 15, 20% over the course of the year. So, don't get too caught up in the volatility in any given year, particularly since we know we're really owning stocks for that long-term wealth accumulation and compounding, et cetera. And that most likely, those manic periods or those depressed pullbacks in any given year are really just Mr. Market giving you an opportunity to add to your long-term positions. And this is just what I like to use. It kind of just shows you. So this is Disney. This is kind of Disney. You can see right here, this big dip was kind of the pandemic, right? Where Disney was closing down their, that's right, yeah, right there, Marcia, where they were closing down closing down the parks, etc. Nobody was going to be going to Disney. Well, all of a sudden, of course, they launched Disney Plus, which was kind of their online or their television offering. And, everyone got super excited about that because everybody was at home. So their subscriber numbers went through the roof. So, there in a short period of time, you had people extrapolating. No one was going to go to Disneyland ever again to, they were going to sign up 100 million new subscribers, every 6 months or every year or something like that. And of course, the truth is you've got a giant business out there. They've got all these brands that have been around forever. They've got content that all of us know. They've only expanded, what content they have with things like Star Wars and Marvel and all those kinds of things. So, the truth is they launch new products. Those products are just now kind of coming to fruition. The parks are kind of operating how they always have. Yet the stock, moved in a 30 or 40% increment a couple of times over that period. So it just shows you how, how crazy it is that the idea that Disney as a business that's been around for over 100 years is going to vacillate, 30, 40% in value over short periods of time. It's just, if you think about it in those terms, it's really just nonsensical. And you want to try to react to those situations where, Mr. Market's either euphoric or depressed, if you like Disney, to either add to your position or maybe reduce it a little bit during a euphoric period.
So you said, Mr. Market, speaking of like that as a, I guess, symbol of the market as a whole, how can you tell when it's euphoric or depressed?
Yeah, I mean, so, that's like kind of one of the difficult things. Although I will say that, it's kind of something that I mentioned earlier that I think is interesting is, it's amazing how, quickly the press will, jump on something when something's going strong. I mean, for a long time, there were a lot of famous, Time Magazine or Newsweek when that was kind of one of the predominant, news vehicles on a weekly basis. And there used to be a study out there that would show that, as soon as Newsweek would put on their cover, market going higher forever, that would, that would be an indication of, when things were about to roll over or, vice versa. Or, there's kind of the famous Joseph Kennedy, who's, JFK's dad, who was a kind of stock market operator. He always had the line that, he got out of the market right before 1929. He was having his shoes shined one day. And the whole time the shoe shine boy was shining his shoes, he was giving him stock tips and telling him what stocks he should own. And he kind of realized, when the shoe shine guy's giving me stock tips, it's probably things have probably kind of gone the wrong direction. So, I think one of the best ways to kind of, figure it out a little bit, and it's impossible. There's no way to get it exactly right. You just want to kind of try to get it directionally right. Is I think the press is a great indicator and a great contrarian indicator, really, of, when you see things like that. Like I said, just in 22, very recently, there was every college kid or there was all kinds of people that were out of work because of COVID, all telling everybody how great they were doing in, XYZ permutation of Bitcoin or whatever it was. So kind of using other people's euphoria or depression as a bellwether for the market as a whole, and the press to kind of amplify how people are thinking is probably at least a decent tool to start with. And like I say, though, it's impossible to get exactly right, but we're just trying to kind of get it directionally right.
Get a comment here. Isn't it common advice to invest consistently because it's so hard to time it and to buy at the correct moment to gain meaningfully from an upturn?
Yeah, and that's exactly right. I mean, that's things like dollar cost averaging is certainly, a great tool. Although, I will say though that, and you're correct, it's impossible to get it exactly right. But, we can look at periods like 2008, 2009, where everything is down, multiple double digits. And, the idea that businesses that have been in existence for long periods of time are really, worth 25 or 30% less over any given period. So, two things. One is you're right, dollar cost averaging into the equity market is great. Conversely, if you have a diversified portfolio, so let's say, a lot of our retiree clients, even though we know the stock market is going to go higher over time, they need to have some less volatile securities so that they can pay expenses in the short term and those kinds of things. What you might like to do in a period of when Mr. Market is clearly depressed, even if you don't get it exactly right, is to now maybe we started out at 60% stocks, 40% bonds. Maybe we want to sell now 10% of our bonds and go to 70% stocks or something like that. So we kind of want to just use these things on the margin, because you're correct. It's almost impossible to predict it accurately. Conversely, if the market's down, double digits, multiple double digits, it's a pretty, good thought process that it's likely to be higher over an extended period. And you could even dollar cost average in your rebalance. So in other words, the market's down 20% and you maybe want to move 10% of your fixed income to equities. Well, maybe you do 5%. Now the market goes down another 20. You could do another 5. So, you're never going to get it perfect, but, you can kind of use that allegory of Mr. Market to, at least get some directional exposure that'll benefit you positively over time. So this is the other one we always like to talk about. I don't know. I always like this, and I feel like as everyone gets older, this becomes, more relevant. I feel like everybody's got the grandfather that tells you how much better everything was before and how bad everything's going to be going forward. But, there does seem to be this kind of, innate human instinct to, assume the worst of things. And we've talked about this maybe before, but, it's a little bit genetic, right? In that, if we think about our ancestors way back when, probably the ones that, maybe were the most pessimistic, the ones that thought there was definitely a tiger in the woods or whatever it might be, those people probably survived. And so from a DNA perspective, maybe it's ingrained in us a little bit. Unfortunately, it is a terrible attribute for investors because, like we say, in general, problems get solved. In general, all that intellectual capital, develops solutions. Like COVID is a perfect example of that, right? Here we had, COVID comes into existence. There's obviously lots of worries surrounding that. What happens? The major pharmaceutical of the companies of the world, the major health agencies of the world, they get together, they innovate, they get an mRNA vaccine that, regardless of whatever you think about that, certainly developed in a record amount of time. And, certainly has allowed us to kind of live with the virus kind of thing. So, humans are very, very good at solving problems over the course of time. We have probably a 3,000-year record of solving problems over time. And so, I think you don't want to get too caught up in the short term. And even, that chart we had earlier of the stock market from 1925 to today, think about all the things you could have been pessimistic about during that period. Great Depression, 2 world wars, Korean War, Nixon impeachment, Kennedy assassination, all kinds of things over the course, Black Monday in the 80s, all these different things that you could have been pessimistic about, yet the economy marched higher. People still went to work every day. People still innovated, et cetera. So, try to avoid pessimism if you can, stay invested, and, history has shown you'll be rewarded for that. So the other one we just talked about briefly is a little bit like, fallacy of experts. And this goes back to a little bit of short-termism as well. Everybody on TV, nobody wants to go on TV and predict that nothing's going to happen, right? That's not going to sell many papers. That's not going to get many people to tune in. And so, everyone wants to go on TV and talk about, exactly what's going to happen, in an upcoming period for a stock or a market or whatever it might be. And, I know we've got a few Warren Buffett quotes in here, but he does tend to crystallize things pretty well. Kind of one of the famous is, he's long felt that the only value of stock forecasters was to make fortune tellers look good. And, if you go to the next slide, the evidence is out there to validate that. So these are kind of the top 10 Wall Street investment banks. They all have a strategist. The strategist will usually at the start of the year make a prediction for what the S&P 500 is going to do, in that given year. And, you can see that the green bars are the forecast, the gold bars are the actual, and, not really a whole lot of correlation between the two bars. And, one of the most famous ones is there. If you see that big gold bar that goes down, which is 2008, and you look at going into that year, right? There wasn't on average, none of those strategists predicted any kind of down market. In fact, they're looking for a plus, 8 to 10 up market. So, in that given year, when all those things happened, and they didn't, it wasn't like they waited till December to happen. Most of the stuff that started to be a catalyst for that started in, February, March of that year. So, it just kind of shows you these are the best and the brightest, supposedly. And not that they're not dumb guys at all. It's a very hard thing to do, but also they have access to, thousands of analysts all over the world, thousands of investment bankers, thousands of company managements, and they still have a very, very hard time, making accurate long-term predictions. It's very difficult for me to think that I could be able to do that, or that, you could be able to do that kind of thing. So, pursuing that as a strategy probably isn't going to be that successful, or utilizing their predictions to how you allocate your assets, probably isn't going to be very successful for you. And this just kind of, magnifies that as well. There's no accountability on the part of a TV commentator for the most part, right? Nobody comes on after I've predicted that XYZ stock is going to do great. They don't come back to me in 6 months the next time I'm on and say, Alec, you did a terrible job. XYZ is down 30%. They actually let me go pick a new stock without even checking on how the last one went, kind of thing. So, Kramer, who is a great entertainer, I'm not sure what else he is, but he's always every day picking a stock, this stock, that stock. Nobody ever goes back and looks at what his predictions were or how they panned out, kind of thing. So, I think if you can. I spent a great part of my career with CNBC on a trading floor with CNBC on in the corner all the time, and we watched it all day. And now I try to not do that, to tell you the truth, because I just think that noise tends to interrupt your thought process. And we go to the next slide. This was just kind of a fun study, or a fun kind of project that was done by a guy named Joel Greenblatt. He wrote a book called The Little Book That Beats the Market. I don't know if anyone ever gets a chance. It's a great book to read, not very long. Expands on a lot of the points that we've talked about here, but he also actually teaches a business school class at Columbia University. And he's done this a few times, but this is just one of the examples, and all the other examples kind of played out the same way. But what he'll do is he'll put a jar of jelly beans up in the front of the room. He'll invite everyone in the class to come down and analyze the beans, count the rows, do whatever methodology they want to utilize, but it's a quantitative methodology, counting, looking, assessing, etc. And what they'll do is they'll write down on a piece of paper that they'll hold in their hand, not tell anybody else, how many beans that they think are in the container. And, after he does that, he has to put it in their pocket. Then he'll have everyone go around the room, and everyone will describe the methodology that they might have used, or how they thought about it, or, maybe something like what their number is or something like that. And then he'll ask everybody to guess again. And, what he found was the first guess, the analytical guess, the average of that was about 771. There was 1776 beans in there. So that's a pretty darn good, wisdom of crowds guess on, how many beans were in the jar. However, after everyone went around the room, everyone talked about what was wrong with someone else's theory, all these different things. The second time around, the average guess was about 50% off, about 850. So, I think it's just a nice story. If you just go to the next slide, just kind of sums up how he thought about it, which was, everybody knows what they're reading in the paper. Everybody, listens to whatever everybody says and kind of internalizes that information, where really, just like the stock market, think about you as a consumer. Example is, I was telling Marche before this, my daughter's in 5th grade. She's just kind of, all these girls have just kind of discovered branding and those kinds of things, So, all of a sudden Lululemon is the hottest thing. All these girls want Lululemon. Well, if my analysis just listening to them was, you'd think Lululemon was going to probably have a good quarter, probably continue to expand. To my detriment, I actually told her I was going to buy her some stock, and I did, and the stock blew out. The next quarter was up 20%. And part of that was because, I went and read a couple of analyst reports that talked about, earnings being, the estimates being too high, all these different things. So, just because you're aware of something in a professional doesn't mean you're not subject to these same kind of foibles. And that's why, we kind of have to identify them and know about them and those kinds of things. So that's just, I think, kind of a good story that kind of gives you some insight there. So, these are just kind of summation of kind of what we talked about today. I think one of the most important ones is that idea of remembering what you own. You do not own a piece of paper. You own a piece of an operating business with all the good that comes along with that, all the people that are going to work and all the labor and all the entrepreneurial spirit and intellectual thought and all those good things. Be patient, think long term. Mr. Market is kind of an emotional business partner, right? We don't really know what's driving that euphoria. He's probably a little bit like the teenage girl, or whatever it might be, or teenage boy. A lot of emotions, a lot of change in emotion, kind of day to day. So be cognizant of that. While it's difficult, try to utilize that to your advantage as much as you can. Tune out the noise. Once you have an opinion or a thought process on something, listening to 15 different other people give you their opinion or why they think that way, you're kind of better off to be your own counsel, I think, in the long term, or utilize a professional. And then, last is just think about simplicity. Try to make things as simple as possible. Try to own, if we're not going to own individual stocks, know that we're just going to own the broad economies of the world, that there's a lot of really good reason why those broad economies expand over time, that there might be, a decent amount of permutation month to month, even year to year, but we can be very confident in the long-term result, just like the coin flip is, permutation flip to flip, but long-term results very close to 50-50. So with that, I will stop and hand it back over to Marche.
Yeah, let's go ahead and take some questions. So the first one is, how do you determine whether it makes sense to invest in individual stocks versus, ETFs or mutual funds? Can you talk about that strategy?
Yeah. So, as professionals, we certainly have, do some individual stocks, although, I think it's a lot more difficult for the individual investor to do that. I think, our kind of general counsel would be that, you're going to have better and less stressful success by focusing on ETF and knowing that you're going to own a market or even an industry, rather than trying to pick and choose, because there is so much variability in an individual company. So just like we talked about, intellectual capital, labor, all those kinds of things, if you pick the wrong horse, even though you might be in the best industry, if you pick the guy that has, whatever other issues that they have, or has the wrong intellectual capital, those kinds of things, you could be very right about what you own, but not make any money. And that goes back to like what I said, Buffett with the airlines. I think autos are another great example of this. When the auto first came out, there was something like 150 companies listed on the New York Stock Exchange the first couple of years. Today there's, maybe 3 or 4 major auto manufacturers in the US left. So, you could have been right on autos, right? Autos certainly replaced horses. I could look out the window and see thousands of them, but I could have made no money on that because I was on the wrong horse. So, in general, back to simplicity, right? Let's own the economy. Let's own that long-term growth of the economy, that long-term accumulation of wealth. While there's certainly nothing wrong with owning some individual securities or utilizing a professional to do those things, I think having that focus on just simply owning the wealth accumulation of a country or the world is probably the best pursuit.
We had a question about how inflation has to do with that chart that you showed, and I'll pop that up at the beginning. Can you talk about how inflation falls into this kind of chart?
So on average, a stock's value should appreciate at basically the level of or the market as a whole should appreciate on as its profitability, level of profit growth plus inflation. So let's just use some round numbers. Let's say that, on average, the profits of a business over a 10-year period are going to grow at 5%. And then inflation is, say, 2%. Your total growth in the stock market should be about 7%. And interestingly, that sounds a little academic, but actually after they've gone back and kind of looked at long-term returns, they pretty much equate to that over the course of time. And, so the reason why owning wealth and owning growth, those kinds of things, is a good inflation hedge is because, once again, these are businesses. So when there's inflation, what are they able to do? They raise the prices of the goods and services that they sell to offset that inflation. So, if we don't own businesses, it's much harder for us to mitigate the effects of inflation than it is if we actually own a business. So the stock market, or really any hard asset, something like farmland that produces, food that we're able to raise prices for, or say properties that we're able to increase the rent at the rates of inflation. Those things are the things that offset the effects of inflation. So stocks are really good things to own in inflation. And in general, the value of your stock should increase, like I say, profit growth plus inflation. The variable in that is when the market's super euphoric, people are willing to pay a higher multiple for those profits. When the market's depressed, people are going to pay a lower multiple for those profits. But over the long term, it evens out pretty closely. Any others?
Well, I started talking and I was
sorry.
on mute. So this is a really great question. My son is just starting out in their first job where they can start investing, and they're in their early 20s. What's kind of they're not asking for individual stocks or anything, but kind of what's kind of a good strategy to begin when you're a brand new investor?
Yeah. So two things there. One is, sit down with your son and go online and just type in, compounding calculator, because I'll tell you that, if you show someone that if they save $50 a month and they do it over 30 or 40 years and it compounds at a 5 or 6% rate, and they see that ultimate number is, $1 million, $2 million, whatever it is, it makes it a lot easier for them to, forego whatever they were going to do with that $50 otherwise, or $100 or whatever it is. So it's a great picture. We use that all the time with, grandkids, kids of clients, because I think it really kind of opens their eyes. And then conversely is, being 20 years old is and being able to invest is an absolutely fantastic place to be, because that chart that we showed you of that long-term growth, that's essentially you today. So, if you can tune out the noise and take this to heart, the fact that, if you invest in businesses and in the economy as a whole, and in the long-term, wealth growth of capitalism, as long as you can just do it consistently and close your eyes and not be too concerned with, the year-to-year variation, you are going to do extremely well. And, even if you just show them, back to that compound calculator on the internet, show them putting in whatever, $500 a year at 8 or 9% equity growth, that result's going to be very attractive. So really at that point in their career, there's two things they want to do. They want to make sure they're putting some money away. They want to be consistent, make it almost the easiest way as it comes out of your check or something like that. And then at that age, you just want to own equities. You want to own those businesses that are going to grow over the course of time. You want to own the economies of the world, the United States, China, Japan, just, the economies of the world that are going to expand over their lifetime. And they're going to be contributing to that, right? They're doing that in their own way. But the nice thing about owning stocks is they get to own a piece of everybody else's labor every day, which is kind of a neat concept to think about.
All right, another question. Can you talk kind of in general terms what a Roth IRA is? It's talked about so much on social media but that doesn't make sense to them. So just
So, a regular either 401k or IRA, so not a Roth, a regular one allows you to put in money before you pay tax on it. That money grows over time. But when you're retired and you go to take that money out, you have to pay tax on that money plus the growth. So what the government did as part of a piece of retirement legislation, I think in the 90s, but I can't remember now, but Roth is really the name of the senator that kind of came up with the plan and launched legislation. But anyway, so what the Roth allows you to do is you pay your tax first. So let's say you earn $1,000 and you're going to put $1,000 of your income into your Roth IRA. You're going to pay your tax first. So you're going to pay, we'll just use round numbers. We'll say it's 20% tax rate that you're at. So you'll put in 800 instead of 1,000. That 800 though can grow in perpetuity, and you'll never be taxed on it again. So what it is it's an advantage because of the fact that you get to have that long-term growth and not pay any tax on it. Now, because of that, because it is an advantage, and because it is a situation where, the government is giving up future tax revenue, not everybody can do it. There's certain income caps on it that you'd have to go through to figure out if you're eligible. Ask an advisor to kind of help you out with that. And then, there's a cap on the amount that you can put in, right? So you can't just go and put in $100,000 or whatever it might be. There's a cap on it. So it's a very, very attractive tool if you're eligible for it. It is and you've maxed out, say, your 401k or those kinds of things, particularly if you have a match from your employer. It's a very, very good tool. The other thing to remember is you have to have earned income. So you can't, say, be in college and not have a job and your parents give you money or something to fund your Roth IRA. You have to have earned income to be able to make the investment. But it's a great tool. It has fantastic tax advantages. Make sure you talk to somebody or do your homework to make sure you're eligible before you do it, because there are penalties, those kinds of things if you don't do it right. But it's a great tool for anyone, particularly for that young person, to utilize.
Yeah, and any advisor is usually able to set that up for you. It's a pretty simple process, I believe. So, and one other question to kind of round things out. You talked about waiting, until you can get a value out of what you bought in your stocks. At what point do you decide to sell?
Yeah, I mean, so it's kind of interesting. So, right, the ultimate holding period, if it's the right business, is kind of forever, because if you think about it, that business is going to continue to accumulate wealth, reinvest, et cetera. Now, like I said, there are certain periods where the market gets euphoric, and like I say, it's very hard to judge. Sometimes selling is almost harder than buying, because you get in certain situations where the stock will get way ahead of itself, kind of how you want to value it. But really, that's okay if you're going to hold it forever, because even if it comes back, it's going to eventually go higher because it's continuing to accumulate that wealth and those kinds of things. So it goes back to kind of what I was saying a little bit about Mr. Market. When you get that impression, when everyone's talking about how great things are, when everyone is, telling you the market's going to go higher forever, when the shoe shine guy is giving you stock tips, that's an okay time to slightly reduce, some of your holdings. The interesting thing about it, though, is this goes back to an ETF. An ETF is really neat versus an individual stock, because there's the tax implications of holding the ETF. So, in an ETF kind of thing, it could go way up, and it's an index, let's say, so it'll be sold inside the index because the value will be ahead of where it might be in the index kind of thing. And so, you might get a tax-free sale. The only thing in an individual stock you got to remember is every time you sell that individual stock, if you've held it over a certain period, and you're going to have to pay tax on those gains. So you're kind of taking some money out of your portfolio that can't compound. But if I had a perfect answer to when to sell something, I probably wouldn't be on here with you guys. I'd be in the Bahamas or something like that. But it's all on the margin, and trying to make, smart decisions based on, what's going on in the world.
We got one more question that came in. I'd love to address that. At what point in your life do you start pulling away from stocks and maybe putting into more conservative options, CDs, bonds, other cash equivalents?
Yeah. So, I mean, this kind of goes back to, the nuts and bolts of what we do for a living. So, a lot of our clients are kind of those people that have, approaching retirement, in retirement, and kind of making that decision. Because if you think about the current generation has had a very kind of wind at their backs from the stock market. So, the 401k came into existence in early to mid 80s. A lot of these people have been in this, invested in stocks at that period. It's been a fantastic time for stocks. And so now they need to make that decision. So, it all kind of comes down to, what your income needs are, how you might want to utilize the assets. But, just as kind of a rule of thumb, what we don't want to have happen is, let's say we're 100% invested in equities, and let's say we have $1 million in equities, and we're retired, and we haven't diversified. What we don't want to have happen is now, let's say we're counting on that $1 million in equities that we have to fund our living expenses in a given year. Let's say we need $50,000 in that given year. What we don't want to have happen is Mr. Market's in one of his depressions. We know he's going to eventually be euphoric. We know things are going to come back, but we have to sell the stocks now because we need the cash itself to fund our lifestyle. So that's when you start to think about, utilizing things like fixed income or some alternatives or things like that. So things that are going to be less volatile, because the stock market, Mr. Market, is crazy, right? So that volatility is going to be much higher than, than we expect it to get to those long-term gains. So as we approach actually needing that money, that's where, we need to make some decisions with part of it. And that's where a financial plan and an advisor, that's really what, like I said, what we do for a living is, helping people transition, mapping out that process, making sure we're doing it in the most tax efficient way. But it's really as you actually need that money that you need to be more careful with what you own, because you do not want to be forced to sell your equities during, Mr. Market's depression.
All right. Well, that's about all the time we have today for questions. We want to thank everyone's comments. We want to thank everyone's questions there. Thank you, Alec, for being here and for the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for you and your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming. Look to your email soon for a link to the replay of this event if you missed some of it or want to share it with your friends or family, or just give it a rewatch. Well, we hope to see you at another webinar soon. Goodbye, everyone.
Thank you, Marcia. Thanks, everyone.